When you have spent enough years building companies, navigating markets, investing through chaos, and watching technology reshape the world again and again, you start to develop a certain intuition about cycles. Not just business cycles or stock market cycles, but human cycles. How fear spreads, how optimism grows, how innovation accelerates when people least expect it, and how the economy, no matter how unpredictable it feels in the moment, always moves in waves. I have lived long enough to see multiple recessions, multiple recoveries, several technological revolutions, and I have learned something simple. You cannot stop a recession. You cannot outvote it. You cannot outrun it. You cannot code your way around it. But you can prepare for it, and if you prepare the right way, a recession stops being a threat and becomes a turning point. Most people misunderstand recessions. They think recessions happen to us like earthquakes out of nowhere, unpredictable and catastrophic, but recessions are not glitch. They are part of the system. They are how an economy resits itself. They shake out excess. They reveal weaknesses. They reward resilience. They punish carelessness. They force clarity. And even though they are uncomfortable, painful, and sometimes devastating, they've always been followed by periods of incredible growth. The key is not predicting the exact day a recession starts. The key is being positioned correctly when it arrives. People often ask me, Bill, how do you prepare for a recession? And my answer is always the same. Preparation is not something you do when the recession starts. Preparation is something you do while things look stable, while things feel calm, while everyone else is relaxed. Because the truth is, recessions do not begin with fireworks. They begin quietly, a few earnings misses, credit tightening around the edges, a slowdown in hiring, consumers shifting from want to need. Then suddenly the momentum breaks and the downturn becomes obvious to everyone. By the time the headlines announce it, it is already happening. That is why preparation has to happen early. And before I talk about strategy, let me share something personal. When I was building Microsoft in the early years, America went through the early 1980s recession. Interest rates were sky high. Inflation was eating into every dollar. People were terrified, and our company was tiny. We were growing, but we were vulnerable. I remember sitting there thinking, okay, we have two choices. We can freeze spending, shrink our ambitions, play it safe, try to preserve what we have, or we can prepare intelligently, assume this recession will end like all others, and position ourselves to grow when the world recovers. We did not panic. We did not overspend. We did not take reckless risks, but we kept building. We invested in product. We kept hiring exceptional people. And when the recession ended, we were miles ahead of competitors who had tried to hide until the storm passed. That lesson has stayed with me for the rest of my life. In every recession since then, I paid close attention to one thing: how human psychology shapes outcomes. Most people wait until the headlines say we are officially in a recession, but by then the window to prepare is gone. So the first part of preparation is simply acknowledging reality. Recessions happen, they always have, and they always will. The question is not whether one will happen. The question is whether you will be ready. Let me give you a broader perspective. If you look at the last 150 years of economic history, recessions come in different forms. Some are credit driven, some are caused by inflation, some are sparked by wars, pandemics, or rapid technological shifts. But across every recession, there is one pattern that repeats consistently. The people who panic lose, and the people who prepare win. And they do not win by predicting the future perfectly. They win by having flexibility. They win by having cash reserves. They win by having the discipline to stick to a strategy while everyone else is driven by fear. So let me talk about cash because people misunderstand it all the time. In normal times, cash is not exciting. Cash loses value to inflation. Cash does not compound. Cash does not innovate. Cash just sits there. But going into a recession, cash is power, it is optionality, it is the ability to act when others cannot. I have said before that having enough liquidity is what allows you to be rational when others are emotional. During downturns, the people with cash are the ones who get to decide, not the ones who are forced to sell assets at the worst possible moment. A recession is like a fire in a crowded theater. People rush to the exits, they sell everything, what price assets irrationally. And if you have cash, you're not one of the people getting trampled. You are one of the people calmly choosing which seat to take next. But this is not just about markets. It is also about your personal life. If you do not have an emergency fund, if your lifestyle requires every dollar you earn, if you are carrying too much debt, the recession controls you. But if you build a 6 month emergency reserve, ideally more, if you live below your means, if you reduce debt while times are good, then the recession stops being a crisis and becomes an opportunity. I have seen so many talented, intelligent people fall into the same trap: lifestyle inflation. It is subtle, it is seductive. You get a raise, you upgrade your apartment, you get a bonus, you upgrade your car, you start flying business class because it makes sense now. You buy nicer gadgets, nicer clothes, nicer everything. And before you know it, your lifestyle rises to match or exceed your income. Then the recession hits, income drops, stress rises, and suddenly you are in trouble. Not because you were not successful, but because you built your life on numbers that assumed everything would always keep going up. Living below your means is not about being cheap. It is about being free, free to invest, free to choose, free to take opportunities when they appear, free to say yes when others have to say no. The people who thrive in recessions are not the people with the highest income, they are the people with the highest flexibility. Another thing people misunderstand is diversification. I have met countless investors who think owning 50 or 100 or 200 stocks makes them diversified. But you cannot understand 200 businesses deeply. You can barely understand 15. Real diversification is not about quantity, it is about quality. It is about selecting a limited group of industries and companies that behave differently during different parts of the cycle. Think about healthcare. People do not stop buying medicine in a recession. Think about utilities. People do not stop turning on the lights. Think about consumer staples. People do not stop buying toothpaste or laundry, detergent or food. These sectors carry economies through tough times. They provide stability. And when you have a stable base, you gain the confidence to take intelligent risks when the right opportunities show up. And let me share something from the tech world because this is important. Some people believe technology companies are always vulnerable during recessions, but that is not true. Strong technology companies with recurring revenue, with deep customer trust, with mission critical products, those companies often emerge from recessions stronger than ever. Why is that? Because recessions forced businesses to eliminate waste. They cut tools they do not need, they double down on tools they rely on. And if your product is essential, your position actually improves. I saw this firsthand with enterprise software companies during the dot-com crash. Most of the speculative companies disappeared. But the companies solving real problems, not hype, not illusions, exploded after the recession ended. That is why understanding business fundamentals is crucial. I do not just look at price. Anyone can look at price. I look at durability. I look at cash flow. I look at how essential the product is. I look at whether the company can survive a 50% drop in revenue without collapsing. I look at leadership. I look at adaptability. I look at whether the company is solving a timeless problem or a trendy one. Recessions expose weak business models. They reward the ones solving real needs. And here's something else I have come to appreciate. Innovation accelerates during recessions. People think downturns slow progress, but historically, some of the biggest breakthroughs from new business models to new technologies came during the toughest periods. The 2008 crisis accelerated financial technology. The 2001 crash accelerated cloud computing. The pandemic recession accelerated remote work, online education, and digital health. Pressure creates clarity. Scarcity forces creativity. Recessions kill the unnecessary and fuel the essential. That is why preparation is not just about defense. It is about positioning yourself for the next wave of innovation. You want to have the resources, the mindset, and the agility to capture new opportunities when they appear. You want to be in a position where you are not overwhelmed by the recession, but instead ready to participate in the transformation that follows. Let me also talk about psychology, because recessions are not just economic events, they are emotional ones. Fear spreads faster than data, panic amplifies faster than logic. And when people panic, they make short sighted decisions. They sell assets that still have real value. They stop investing in their skills. They freeze their ambition. They shrink instead of adapt. And that mindset can set people back years. But if you treat recessions as temporary conditions, and they always have been, you maintain your long term perspective. One thing that helped me during difficult periods was simply stepping back and looking at how innovation operates on long time horizons. Good ideas do not vanish because gross domestic product falls for a year. Strong companies do not disappear because consumer spending drops temporarily. Technologies that are inevitable do not become avoidable just because the market is scared. A recession can delay progress, it can slow it, but it rarely reverses the underlying direction of innovation. That is why I always encourage people to invest in learning during downturns. Read more, study more, upgrade your skills, strengthen your expertise. The world changes quickly, but recessions create a rare window where competition slows down. People stop improving, companies slow hiring, and if you use that time wisely, you can leapfrog others when the economy recovers. One of the best investments you can make during a recession is in yourself. The market crash can take that away. Another mistake people make is consuming too much news during recessions. The news becomes overwhelming. Every headline is negative. Every commentary predicts collapse. Every forecast grows darker. But you have to remember something. Fear gets clicks. Anxiety grabs attention. Catastrophe sells. If you let the news shape your emotional state, you will end up paralyzed. So stay informed but disciplined. Read once a day. Check the data, understand the fundamentals, then step away. Do not let panic driven narratives control your decisions. Let me share another lesson. Never let debt control your life. Debt turns normal downturns into personal disasters. I have watched smart, capable people go under not because the recession was too big, but because their leverage was too high. Debt narrows your options. It destroys flexibility. It forces you to make decisions you would not make if you were free. If you want to thrive in a recession, eliminate consumer debt as fast as possible. Pay down high interest loans. Avoid borrowing for things that depreciate. Own your life instead of renting it from lenders. And here is something I have observed over decades of watching entrepreneurs. Recessions separate those who build from those who borrow. Builders adapt, borrowers collapse. Builder innovate, borrowers panic. Builders use recessions as strategic. Borrowers see recessions as punishment. If you want to be one of the builders, you need a foundation of simplicity, discipline, and cash. Now, let me talk about the difference between price and value, because this is one of the most important concepts to understand going into a recession. Price is what something costs today. Value is what something produces over time. During recessions, prices collapse quickly, but value collapses slowly, if at all. That gap is where opportunity lives. If you understand the true long term value of something and everyone else is panicking about short term prices, you have an enormous advantage. You get to act rationally while others act emotionally. Think about it this way. Imagine a company that produces a product the world will still need 10 years from now: software, medicine, food, clean energy solutions. That company may see its stock price fall 40% during a recession, even though its long term future is not changed at all. When the panic fades, prices rise to reflect value again, and the people who bought during the gap benefit the most. That is why studying history matters, not because history repeats perfectly, but because human behavior repeats consistently. People overreact, people assume downturns will last forever. People forget that every recession in history has ended. Some lasted a year, some lasted two, some lasted longer, but every single one ended and the world moved forward. Immonation continued, companies grew, markets expanded, lives improved. The long term story of human progress did not stop because of temporary economic contractions. Beyond the numbers and charts, there is a very practical layer to all of this that applies to your daily life. Preparation before a recession is not just a line item in your investment plan. It is in how you design your monthly budget, how you talk about money with your family, how you decide what really matters before a downturn. It is incredibly powerful to sit down and separate your spending into what is truly essential and what is optional. Food, housing, basic utilities, health, education, those are core. The streaming subscriptions you do not use, the third delivery app, the constant upgrades, those are optional. If you know in advance what you would cut if things got tough, you do not need to panic when they actually do. You simply execute a plan you already agreed on. Technology can also be your ally here. You can wrap savings, you can set up regular small investments into broad, low fee index funds so that you are not trying to outsmart the market every month. You can use basic tools to track your spending and see where your money really goes. None of this is glamorous. You will not see it on the front page of a technology magazine, but small automated habits built before a recession become the backbone of your resilience during it. Another angle people overlook is geography. We live in a global economy now. A recession in one country may not hit every sector and every region equally, so that you can work remotely, collaborate across borders, or participate in global industries gives you another layer of protection. If your income is tied to a single local employer, a single city, a single industry, you are fragile. If your skills let you contribute to different markets or different types of work, you are more adaptable. Recessions reward adaptability. I also think a lot about the next generation when I talk about this. Your kids are watching how you respond to stress. They see how you react to bad news. They hear what you say about money, careers, risk, and failure. A recession is a powerful moment to teach them that setbacks are part of life, not the end of life. You can show them how to adjust, how to cut back temporarily without losing dignity, how to stay generous even when things are tight, and how to keep learning no matter what the economy is doing. That mindset, once learned, outlives any single downturn. There is also a health dimension that people ignore until it becomes a problem. Recessions are stressful. Stress impacts sleep, decision making, relationships, and even physical health. If you want to be effective during tough times, you need to take care of your body and your mind. Exercise, basic sleep discipline, time away from screens, real conversations with people you trust. These are not luxuries, they are part of your strategy. A calm mind makes better financial decisions than an exhausted one. A healthy body can endure more stress than a fragile one. Recession preparation is not just about spreadsheets. It is about your capacity to think clearly under pressure, and there is one more layer that matters more as you get older. Contribution. During downturns, the gaps in society become more visible. Some people lose their safety nets entirely. Food banks get crowded. Schools and community centers feel the strain. If you are fortunate enough to be in a position of relative stability, a recession is not only a chance to protect yourself, it is a chance to step up for others, giving your time and seeing someone who just lost a job, sharing knowledge, supporting organizations that catch people when they fall. These actions not only help them, they keep you grounded. They remind you that your life is more than your portfolio balance. Recession can also be a powerful reset button for your own priorities. When the world slows down and illusions of endless growth are challenged, you get a rare moment to ask deeper questions. Is this career path still the one you want? Are you building something that matters to you? Have you been postponing important changes because it was easier to ride the momentum than to steer your own direction? Some of the most important life decisions people make happen after a crisis, not before it, because pain has a way of clarifying what really counts. So when you think about preparing for a recession, do not limit the idea to money. Yes, build cash reserves. Yes, avoid debt. Yes, invest in strong businesses if you invest at all. But also build emotional reserves, build skill reserves, build relationship reserves, build health reserves, build reputation reserves. If people trust you before a recession, they're more likely to work with you during one. If you have a track record of being reliable, honest, and adaptable, opportunities find you even in bad times. A recession is not just an economic event, it is a character test. It reveals how prepared you are. It reveals whether your habits were sustainable. It reveals whether your decisions were wise. It reveals whether you built your life on a foundation of discipline or on a foundation of wishful thinking. The people who thrive in recessions are not the lucky ones. They are the prepared ones. So if you want one simple strategy before a recession, it is this: prepare early, prepare rationally, prepare consistently, and prepare with the mindset that downturns are temporary, but opportunities created during downturns can change your life permanently. Build your reserves now. Strengthen your skills now. Simplify your finances now. Create your opportunity list now. Reduce your expenses now, and when the next recession arrives, you will not fear it. You will be ready. And if this message resonates with you, do not just nod and move on to the next video. Do something tonight. Take one small step. Build your emergency fund. Cut one unnecessary expense. Make a list of companies or skills you want to invest in. Share this mindset with someone you care about so you're not preparing alone, because recessions do not reward hopeful thinking. They reward preparation, and your preparation starts right now.